everyone. ICS welcome you all in this another exciting seminar of the Niryat Series, which we are hosting at WRC. Before we begin, I request everyone please place your hand on heart for ICI motto song.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Welcome back. Friends, by this 1st of July 2023, as a ICI, we have entered in the 75th year of our existence. And this pride we are celebrating in a different way at WRC because we have more than 168 branches. We are the family of 12.5 lakh members and students. And we have presence globally in 48 countries through our representative offices or our chapter offices. And in this series, this is the great initiative of the WRC that in Niryat Series, we are connecting with all the chapters across the globe of the ICI to explore the opportunity for each other. And this series we have connected for Australia also, for Doha, for now we have connected for Abu Dhabi, for Dubai chapter also. And then today we are connecting with the very dynamic chapter of the ICI, that is the Singapore, in this series. So friends, this year we are celebrating the pride of ICI in WRC, and we are saying that P stand for to perform. Why we are saying to perform? Because we are in the 21st century and India is leading globally. We are the pharma capital, we are the software capital, we are the 5th largest economy in the world, and we have 3rd largest ecosystem in startup space in the world. We have the youngest population of the world in India, and that is why we are saying we have to perform as per the opportunities available in the market. And then R stand for relearning, because we are saying we have to relearn all the things as per the need of the R. And that again, I stand for innovation, and which is our core. We are in the era of digital. We are in the era of technology where innovation is very important, and we are bringing under the able leadership of Sri Arpit Kabraji, who believe in innovation, and we are bringing all the innovation under WRC at the most. Now, D stand for distinguish, where we are saying we have to create something specific for our members, and that is why we are organizing various programs at WRC. We have organized program for insurance sector. We are planning to have program for banking sector also. We have already completed a program for mutual fund industry, pharmaceuticals. So that way we are trying to create some distinguished market for all our members to empower them. And then E stand for enrich our ecosystem, where we are in the era of ESG. You can say we are in the era of social audit, where 3 Ps are very important. First, we have to understand for profit, planet, then people, and then profit will make sense. So that way we are celebrating that pride at WRC. And today we are fortunate to have the presence of our dynamic chairman of WRC, Arpit Kabraji, with us in this series. And we also have presence of CA Ramki Subramaniam sir, immediate past chairman of ICI Singapore chapter. So first, I like to request the dynamic chairperson of the WRC, CA Arpit Kabraji, to address all of us.
Thank you, Saurabh. Good evening, everyone from India and Singapore and from rest of the world. Welcome to this yet another episode of Niryat Series. I welcome Sanjay speaker for today who will be talking about the family offices, a lot of funds that he'll be talking about, and a lot of investment decisions. I'm sure that will be very exciting. We've got Adriana over here. Thank you, Adriana, for joining us for this wonderful topic, wonderful session. Hemant, who's joined in who's from the ICI Singapore, and Ramki, who's the immediate past chairman. Somnath ji couldn't make it for some urgent purposes. I think he just moved away, and therefore Ramki sir has joined us. So thank you very much for joining in at the last moment. Really, it's a pleasure to have all of you. These initiatives bring not only the ICI chapters close. At WIRC, we have made an initiative. We've reached out to everyone and thought of really creating some capabilities for people on the other side of the horizon as well. And therefore, this entire session has been lined up, keeping in mind both the jurisdictions. And I'm sure with more and more networking, people who are there, they can just, as people have written on the chat boxes, they can introduce themselves. There'll be some networking questions. And you never know, a big breakthrough could have you maybe working here from India or could be working in Singapore. Let me remind all of you, we had a wonderful conference, Resolve, of the insolvency at Singapore, much talked of, and a very, very large, significant conference, thanks to ICI Singapore who hosted it. So with that in mind, I think we've hosted this session as well. With various initiatives at WIRC that we have, Wednesdays, we talk about women on Wednesday. Thursdays are reserved for technology. So we have all Thursdays, we have programs on technology. And I'm happy to share with all of you that, recently we spoke about an open AI platform which does legal drafting freely, just like a chat GPT. We've got a legal GPT which does all the legal drafting. We've fed it with all the legal case laws and all. And believe me, if you need a submission on penalty, if you need a submission on anything, it's readily drafted. All you need to do is just to whom do you have to submit that submission? You have to put that flavor in, and that is it. That was live on this virtual platform that we showcased. Fridays, we have programs on Friday Fundas. We have Nest Cafes. We have Gurukul at WIRC. I will request Mishra ji to put up the slide once so that, for all of us to have a look at the events that we have at WIRC. And most importantly, Project Vasundhara. I think for greener balance sheets, these are some of the events, these are some of the programs that we have launched. Startup Lab, again, a very important initiative where we call in all the angel investors, we call in different partners, different parameters of startups, and we discuss a lot of this, and we are ourselves setting up an incubation at ICI, at Mumbai, at WIRC. So all of these is what we are doing at WIRC, and I'm glad that we could share this with Singapore. We'll be more than happy if at all we want to do some programs collectively on this. And one project Saptrishi that we started is for academicians and professionals to come together and see if we could develop commerce students into wonderful accountants that can serve this entire growing economy. So with these words, I really welcome all of you, and I'm really happy to have this program jointly with ICI Singapore, and look forward to more such programs together. Over to you, Saurabh.
Thank you, Chairman Sir, for enlightening us about all the initiatives of WIRC. And it's absolute pride for us to have a session in this Niryat Series with Singapore chapter of ICI. And I welcome to address CA Ramki Subramaniam Sir, immediate past chairman of ICI Singapore branch. Over to you, sir.
Thank you, Saurabh ji. Thank you, Arpit ji. Good evening, dear members of ICAI Singapore. Good evening, dear members of Western India Regional Council. It's a pleasure this evening to welcome all of you for this first joint event webinar on a very pertinent topic in today's environment on fund management, family office, and transfer pricing. It's a very pertinent topic, and we are blessed to have two eminent speakers for today's session, Mr. Sanjay Guglani and Ms. Adriana Caledron. We thank them for taking time out for our members. And special thanks to Hemant as well to be the moderator for today's session. Thank you once again, CA Arpit Kabraji, under your dynamic leadership, WIRC is going places. So with that, let me welcome the speakers and looking forward to a really enriching session for all the members.
Thank you, Ramki sir. Now I request Hemant Geriani to take the charge of this session.
Thanks, Saurabh. Thanks a lot, Arpit and Ramki, for the opening speeches. And Arpit, I must say that you are doing some really exciting work in terms of the series, what you are doing, and it was really an eye-opener for us. So thanks a lot. We would like to replicate some of it in ICI Singapore, and maybe some in collaboration with you guys. So well done and keep it up. Thanks, Saurabh, for passing the baton to me. And I will not take much time between the formal proceedings and the business. I would like to introduce, he doesn't need any introduction in the Singapore market, but I think let me just read out a little bit about CA Sanjay Guglani, who is the founder and CEO of Silverdale Funds. He's a chartered accountant, management accountant, company secretary, and Sloan Fellow in management from London Business School. He has over 3 decades of investment experience. He has launched one of the first retail portfolio management scheme in India in 1991. He established the Silverdale Group in Geneva and London in early 2000. Launched funds in Mauritius, BVI, Cayman Islands, and Singapore. He has channelized 6 billion of investments in Asia economies. He's managing over $1 billion of assets across a dozen of funds. Some of them are open-ended funds like Silverdale Bond Fund, Silverdale Asia Bond Fund, Silverdale S-REIT, and others. Apart from that, he has Silverdale Fixed Maturity Funds, Silverdale Bespoke Fund Solutions. So a lot to choose from in terms of under his kitty. Apart from that, he has represented India at United Nations, been on national advisory councils, guest faculty at various B schools in Singapore and India, and acclaimed speaker at conferences, TV shows, radio shows, magazines, etc. So this is a brief summary of what Sanjay is all about. Sanjay, we are looking forward to an exciting discussion or presentation by you. So the way we like to proceed is that we will have 40 minutes for you to make the presentation. We will take all the questions after that in the next 10 minutes. So I would request all the participants to key in their questions in the chat box, and Sanjay will try to answer most of it, whatever he can do in 10 minutes. And otherwise, he has kindly agreed to reply to them directly once he shares his details as well. So as a disclaimer, because we are representing professional bodies, we are not endorsing any funds or any of the individuals or esteemed speakers at this point in time. And it's just a knowledge series, which we are trying to do between ICI Singapore and the Western India Regional Council. So over to you, Sanjay, for the next 40 minutes. Thank you.
Thank you, Hemant. It's indeed a privilege and a pleasure to address all of you. A special thanks to CA Arpit, CA Ramki, Saurabh, Hemant, and of course my co-panelist, Adriana. Without further ado, let me just come directly to the presentation. And as Hemant Bhai had mentioned, these are basically idiosyncratic views of mine, nothing to do with reality. So before you take any tip from it in terms of investment, please do consult your friendly investment advisor. And of course, chartered accountants are good chartered advisors, I can tell you for certainty. So in terms of the rollout for today, Hemant has already mentioned about myself. We started in early 2000 in Geneva and London. We are located in Singapore. Both the fund and the fund manager regulated by Monetary Authority of Singapore. So many of things which I will talk about will be biased in terms of Singapore laws, but feel free to ask me about Cayman, Mauritius, other laws where we do also have funds. So we are basically in Singapore. We are managing about $1 billion across open-ended, fixed maturity, and bespoke funds. So first and foremost is, what is a fund? That's the first foremost thing to understand. So fund is nothing but, as you know, a collective pool of money taken from investors to invest into various specified securities. And whatever the fund earns, it gives, of course, to the investors in the proportion of the investment they have made. So first thing I want to highlight is, when we talk about fund, we talk very generically. Effectively, the fund at the block minimum contains 2 firms, the fund and the fund manager. This is very, very important because as we go further, we make a distinction in terms of what is done by whom and why. Before that, why should you look into fund at all? And I would strongly recommend you to look at from the fact that since 2008, we have seen a very, very, very sharp increase in the fund, right? Both in terms of professional funds. So if you look in terms of globally, most of the mutual funds in the world which are coming nowadays are corporate structure and not the traditional trust structure which is common in India. And the other thing is always that the lot of private funds are coming into play, a lot of bespoke funds are coming into play. So the first question which always comes in the mind is, why should you create a fund and why not, and for example, a BVI company? So let's compare between a BVI company or for them any offshore company, a trust structure and a fund. The first and foremost is that if you were to have a proper fund structure in a jurisdiction like in Singapore, you would effectively could end up having zero taxation on all your investment income. So for a family which, for example, keeps the money there for next 20 years, they effectively pay zero tax, which basically means your money compounds at much, much higher rate. For me, the second is even more important, which is in terms of direction and control. As always joke, and I'm please take it as a joke. So see, in case of fund, if you control the fund, you lose the tax benefit. And if you don't control the fund, you lose the fund. So from that point of view, having a formal fund structure is very important because you do have a legislative backing to take care of it. We know of n number of stories as chartered accountants where things have gone away because of the fact that the person, the benefactor who actually established a trust was no more there and things went for a problem. So there are multiple advantages there. The other very important advantage is, of course, the fact that it can be done across various jurisdictions. And this is very important again. So as you know, as chartered accountants, that a trust is typically not eligible for double taxation avoidance treaties. And today, most of the families, most of the investments are global. So from that point of view, again, having a fund structure makes tremendous sense. And as I'll explain in the last portion of my presentation in terms of illustrative transactions, there are a lot of interesting things which we can do by using a fund. For example, in terms of club deals, in terms of non-recourse funding, in terms of putting monies into new startup, avoiding PGs, to create a holistic structure, etc. there. The other important thing is what our chairman here, RPG, mentioned upon briefly, which is in terms of the transparency which we are seeing increasingly in the world. And from that point of view, fund is very interesting because on one hand, it gives you 100% transparency and control when it comes to investments, yet gives you confidentiality when it comes to name of the investors. So the brilliant situation to be in where your working becomes much more smoother and efficient. At the same time, you're not handicapped in any manner in terms of controlling out there. I want to touch briefly upon something which is very, very commonly confused upon. And this is for me the very important thing, very simple thing, but very important to understand. And specifically so by my Indian friends, because this does not exist in India. So in the traditional point of view, what is a fund? Fund is nothing but a company which is a license to run it. Right? Just like a corporation which has a banking license is called a bank. A corporation which has the fund license is called a fund. And like any other corporation, there will be, of course, certificate of incorporation, there will be memorandum of association, article of association, and operating rules. Now, think of it that I have, for example, I have 17 funds and 17 of certificate corporations and M&As I have, which are practically no value. So the thing to highlight to you is in two dimensions. First, a multi-class fund versus a segregated portfolio or sub-funds, etc. Multi-class fund is like a room in a hotel. If the hotel catches fire, you would be burnt, love it or hate it. Whereas a multiple portfolio or sub-fund structure, each fund is legally segregated. Think of it like McDonald's franchising. God forbid, if the franchise in Shanghai catches fire, you in New Delhi have no issue whatsoever. So the first distinction to make is in terms of multi-class versus, segregate portfolio stroke sub-fund structure. So coming back to where I took a digression, so traditionally this is how the funds were being done. What the Singapore government has done is created a VCC structure, variable capital company. And what they told is that the certificate of incorporation, the memorandum of articles, and articles of association would all be common. The operating things, how it works, would be put into a class supplement. Now, the beauty of doing this structure is once your basic core VCC setup, you can put new funds as and when required. And at the same time, it is extremely efficient. You can put a new fund in about 2 to 4 weeks flat. So when you get a good strategy, a good opportunity to invest, you can create a new fund so if you so want and launch it rather than taking the whatever few months or a year to establish a separate fund. In terms of VCC, very important because VCC is one of the rare structures in the world wherein the segregation is by the law and not by documentation alone. For example, for our Cayman fund, the segregation comes because of documentation. So when we incorporated the fund in Cayman, we incorporated a company, and then we converted company into what's called SPC company. Right? So remember, the company was one company, and we do need documentation, namely the prospectus, in terms of breaking it or other segregating it across of there. Once in Singapore, where when we incorporate the VCC, we cannot incorporate VCC without sub-funds. So the sub-fund begin from the beginning, right from the beginning. And there's segregation of that. So without getting into too much of technicals, it really is important, specifically when you start looking into larger funds in terms of risk of enforcement. So we talked about the VCC and the various advantages to it. Before even going further, let me quickly do an overview. So as we all understand, we have open-ended funds, which take subscription across the board. We have closed-ended funds, like the fixed maturity funds, which are typically for a designated investment or a venture. Then we have, of course, interval funds, including the classic 7+2+1 for private equity. You invest for 7 years, you can get 2 years more to invest, divest, and money extension out there. Important. We can also look funds from the point of being active funds, which target generating alpha, giving you return better than the index, as well as passive funds, which typically track an index and avoid having tracking errors. Of course, you can have different sort of funds, in terms of equity, bonds, commodity, real estate, even cryptocurrency, wines, the land, cattle field. You can think whatever you can think, you can create it into a fund structure. I was reading yesterday The Economist, which talked about even having a fund structure where you can participate in the turnover of companies. They are it. So the key takeaway to you is you can look at the funds in various fashion, but when you talk about fund, remember a fund without the limbs is of no consequence. So among the 2 slides on the fund I would want you to take away is one is this. Then when you talk about fund, remember fund by itself has no worth unless until it has a gamut of things goes with it. Of course, number 1 is chartered accountants, which is that, we require the auditors. But yes, before that, we require the legal counsels. We require the fund administrator, which is a polite word of chartered accountant doing accounting work. And of course, the things along with it. Registrar transfer agent. We're talking about in terms of the various regulations. So we have the FATCA agent, we have the CRS, common reporting standards, for which you need to have agent out there. Time permitting, we talk about it in more detail. In compliance, of course, you need to have the anti-money laundering officer, the anti-money laundering officer, and then all the gamut of things goes with it. Unlike in certain jurisdiction, in case of Singapore and most of the developed world, the liability of a professional is unlimited. Therefore, should you go on the path of putting a fund, very strongly recommend whether it is recommendatory or mandatory for you to look in terms of insurance. The critical thing which you will also face is in terms of the banking accounts, custody account, and the prime brokers. Prime broker, just to remind you, is a person who does all the gamut of the settlements and the trading, including giving lending. So a broker plus a lender plus custodian would be broadly be what is called a prime broker. So there are 17 different parties which are involved in terms of running a fund. And of course, out of which I've already excluded some party which you're very much familiar with is our Mr. Regulator. We can't live without those. In terms of our taxation authorities, in terms of the various jurisdiction where the fund is being registered. So now we know what are things which we require. So let's look in terms of if you were to create a fund, what does it entail? So when you want to create a fund or a sub-fund for that matter, the first and foremost is to begin with the term sheet. Term sheet is very, very important for you to be able to crystallize what you intend to do. And for me, that's like the framework agreement. So as chartered accountants, I would strongly recommend, please spend more time in terms of creating the term sheet. Like a term sheet is the mother document which will actually define how the fund will be run. So don't take it for granted. Please look into deep details. After that, it's a very much a mechanical flow, because the term sheet, which are the terms agreed between the fund manager and the investor, get dovetailed into the class supplement stroke private placement memorandum. And once that is done, then of course all the documents flow from it, namely in terms of the fund administration agreement, the fund management agreement. Fund management agreement is very, very important, and I will touch upon it in my subsequent slides further. Fund advisory agreement, if there is any advisor to be there, and of course other things like the compliance, the AML and registrar, corporate secretary, etc. out there. So the two key takeaways are the fact that number one is be aware that a fund is of no consequence unless you can get the whole gamut of relationship along with it. And number two, be aware of these all critical documents which define how the fund will be run and defines how the investors will be remunerated, stroke even the managers, etc. will be remunerated out there. So that takes us to the critical points as chartered accountants. What are we need to take decision points on? So these given time constraint, I will just highlight to you, and I want to highlight to you because with all humility of being in the industry for 30 years and launched funds in 4 jurisdictions, I should very humbly and politely point out to you, I haven't found a single firm which is able to highlight these to the clients. And I'm not too much surprised, because when they talk to the accounting firm, they give accounting aspect. When they talk to the management firm, the management aspect. When they talk to lawyers, they give lawyer aspect. So I want to bring on table all most of the critical points which are not talked about. Beginning with, of course, the first step, the most important thing is the valuation of the underlying investment. What do you mean by value? How do you define it? How do you value with certain things or equities or bonds? How will you get the price? How frequently you get the price? How much variation you'll accept? How will you derive the ultimate price? Let me give a very simple example to explain this shit. Think of any company, like any equity. Typically, global equities will win multiple stock exchanges. Which stock exchange price would you take? Depending on liquidity changes from stock exchange. You can't change the stock exchange every time you price. When you're valuing a fixed income instrument, the first thing is, what's the risk-free rate? Oh, I'll take US, fantastic. 5-year, 10-year, 30-year. Oh, I'll take 10 years, fantastic. On which exchange? I stock exchange, business stock exchange, which exchange? Oh, I will take I stock exchange, fantastic. What time? 10 a.m., 12 p.m. California time, New York time. These small things, but very, very critically important thing. The reason I'm highlighting to you is that these are part and parcel of the operating manual, without which you cannot proceed. And as auditors, when you look in terms of the underlying instruments, these are things which you need to be aware of. I do appreciate, for that matter, India has some, I would say, frameworks thanks to the SEBI and C Institute, but globally it's not that easy. One of the biggest things, at least we have discussion with the auditors in terms of disclosure level 1, 2, or 3. The biggest issue which we have as fund manager is not that we do not know what am I speaking, because we do it for a living when I manage a portfolio. But do you really want to talk to your auditor about it? Because you are not supposed to be involved in terms of pricing. So you jolly well have a manual which explains the waterfall, like how the pricing will come. If there's no price for next 90 days, this is the fallback will happen. If the variation is so much, this is how we'll do it. Why would you geometric mean and not an arithmetic mean in terms of the pricing sector there? Why would we would not look into anything which is 2 sigma away from the mean of the price of a security? When you launch a fund, there will be some expenses. Who will bear the expense? Even common expenses for that matter, for example, in terms of the office rent, in terms of the director fees, in terms of insurance policy. I launch a fund, or rather, it's a VCC fund with 2 sub funds. And during the year, I launch 1 more sub fund. Now, what do? What in case I close one of the funds because it reached a maturity? How do you account for it? Because remember, each sub fund is separate. If each sub fund is separate, then the director who sits on the Silverdale Fund VCC, the parent, the umbrella, whatever you like to call it, who is going to bear the expense? In whose name would the invoice be there? Because the parent, the umbrella, cannot have any asset or liability. Even the Bloomberg invoice, tell me, whom name should I get it? Should I get in the parent, the umbrella name, or in the name of a sub fund 1 and sub fund 2? Mr. Bloomberg doesn't give me 4 invoices for 4 funds I run. And even if he was to give to me, remember, I'll put 2 more funds during the year and ask him, this time give me 6. No, sorry, this time give me 5 because I have closed a fund. Come to the marketing expenses of it. So when you are launching your first fund, you need to spend much more amount in terms of marketing than, for example, like in my case, like 23rd fund. So question is that what were the initial marketing expenses? Is those expenses of the fund manager, or are they really of the fund? How much of which would be deferred revenue expenditure? How much we can capitalize it? How will amortize it? How the 12B1 works? And the biggest thing where we as chartered accountants can contribute as professionally as chartered accountants, and of course for other practitioner, is the taxation. I did talk about the fact that Silverdale funds have tax exemptions, so we pay 0 tax on investment income. Why do we do that? How do we do that? Oh, we have 13U exemption. How does the 13U exemption work? If anybody of you has tried to launch a fund, talk to a fund, did any of your consultants talk about GST? Did they explain to you that the GST number for each sub fund will be obtained separately, and that you cannot obtain it, anybody have to obtain it? Funny, no? You have to obtain separately, but you can't obtain it, but you still have to obtain it. How does it work? What are thresholds? And most importantly, remember that you have a GST remission, for example, in Singapore. How do you qualify for it? If the fund was to pay a marketing commission, what about the reverse charge? And remember, most of the people, those who launch a fund by definition, would be working with the related organization, and they would have some substance, some basic things before they launch it, right? They may be into allied business for them, but they could be in financial service, they could be NBFC, they could be stockbroking firm, they could be wealth manager, which means additional complication to you. How do you cost for the common infrastructure, the director's remuneration, the marketing support? Or to put it in one word, transfer pricing. I'm sure my co-panelist, Adriana, will go in more details there. Because these are things which will actually matter to you as chartered accountant when you're looking into a fund structure. And then, of course, these are the only things which I've highlighted to you, which are directly in where a chartered accountant is involved in decision making. But there are also some things which other things need to be taken care of to understand, for example, how the FATCA Model 1 or FATCA Model 2 works, how the PDPs, how the CRS, how the FATCA sector work. As many of you know, MS come with the guidelines in terms of risk-based capital. Good news, as chartered accountant, most of us people know how it works, but to see for the first time how we'll do the reporting, it will be interesting. So the key purpose of my presentation today was to highlight the lesser known points which people don't talk about in the gamut of what I told earlier, which was in terms of the parties involved to create a fund, the documentation agreements involved. And to conclude, the last slide on this would be in terms of the cost and timeline. First is in terms of timeline. So if you're talking about a fund launch, my experience from the colleagues, the sector talk to people, is typically at least 6 months to a year time, if you are lucky. And I'm using the word if you're lucky. Please appreciate the regulator would give a certain timeline. They're absolutely correct in the timeline they're given. But the key point there is after you have submitted all the documents to them, and therefore the difference of that. So first thing you have to be aware of is in terms of the setup cost. And there is where, again, as chartered accountant, you have to decide between manufacture versus buying out. The classic distance we had in our CA course. Should you manufacture it or should you actually buy a third party? So my strong recommendation to people is that unless and until you really want to get into fund management, it may be much more sense for you to quote unquote hire the fund rather than create your own fund. By hiring the fund, you reduce your time to market from almost 1 year to less than 1 month. The cost will be about 1/20th of what it would be otherwise. Right from the setup cost, which will be hardly a fraction of it. And for right size, of course, most of the fund houses which do bespoke fund would be happy to even vary it out there. And management fees, of course, depends on the parties. In terms of administration fees, which covers the various adjunct parties, which we talked about, would be about 10 to 50 bips there. In terms of the entry, exit, and other operating expenses would be there. What I would strongly recommend is that the success of any project is in planning. So please plan it very well. I've taken the Gantt chart, which we use in our CA final year, just to say that you can go as basic as that. But yes, if you have heard the sector, it'll be much better. But please do not embark upon creating a fund without having all the pieces in place. And therefore, please spend some time in grinding the X before cutting the tree. So on that note, this concludes my first fundamental foundation in terms of the fund structure. In terms of family office, as you know, the core function of family office is to preserve wealth, and this is very, very, very important, specifically for people from India, because India is on a very, very sharp growth trajectory. We expect India's GDP to double up next about 3 to 5 years, and very, very important, people would change their outlook in terms of enjoying life rather than earning. And I want to put a small note there. Please appreciate, I'm talking for myself. If my parents didn't work, they would have died of hunger. If my children don't work, it's perfectly fine. And that's true for majority of the middle class. And therefore, the preservation of capital is very important. And therefore, having it professionalized is very, very important. And that's the reason why the family office becomes so critically important. We've already seen why family offices, specifically since 2008, prefer a fund structure over classic trust structure. To quickly highlight to you, in terms of family office in Singapore, you need to have 20 million stroke 50 billion to get the waste tax exemptions. You need to have 2-3 professionals with about 10 years of experience. You need to invest 10% of AUM in Singapore. And of course, I'm being charitable here to talk about you being able to set up in next about 6 to 18 months. While if you hire a bespoke fund, nothing of this applies to you, and your time to market will be as much as 1 month. So just to keep this in mind, if you are traveling to Singapore, please take a hotel room rather than buying a hotel. That's all I have to say there. So in terms of bespoke fund, when a fund house creates a bespoke fund or exclusive fund for the family or the bank or whatever it be, it gives them 100% control of the assets underlying, 100% transparency with the confidentiality of client data and independent reporting set out there. Why should you do it? In terms of explicit advantages is, of course, the tax benefit, which you talked about. In case of Singapore, of course, we have 97 double taxation avoidance treaties, which benefit there. We have nil taxation of all investment income. The cost of borrowing for a fund house like us will be between 20 bips to 75 bips, almost half of what would be there for classically for an individual. And of course, the huge amount of infrastructure which any fund will bring on table. So coming to the core again, so the fixed income is of course at the core of most family offices because from long-term point of view, I'm talking about last 23 years, including the superlative year post-COVID for equities, the annualized return between equities and bonds is very, very, very similar. So it's about 6.75, 678 versus 6.2. Even across last 100 years, if you look, the difference between equity and bonds is less than 2% per annum. So again, to highlight to you, it makes tremendous sense for people to look in terms of the opportunities there. And that's exactly what's happening, whether you look in terms of the Goldman Sachs report or you look in terms of the UBS report, we are seeing significant allocation of the family offices to fixed income. And to conclude this point, let me quote from the Federal Reserve Bank of US research paper, which talks about the fact that 40% of all profit of the corporation in US from 1989 to 2019 was because of lower interest rate and taxation. And this is, remember, the Fed Bank telling to people at large, to the various banks, institutions, investors, that in going forward, the returns from these equities will be significantly lower. And hence, very important reason why to look into fixed income. In the interest of time, I would just skip most of this. I'm sure you know about it. This fixed income is about $300 trillion asset class across the board. And in terms of emerging market is 70, almost 70% approximately in terms of IG, yet they pay you a higher return. The investment grade, of course, is anything above BBB minus and above. I want to highlight this to you because roughly about 70% of the bond fund managers in the world get it wrong, as per University of California, which is to remind you that the return from a bond portfolio is always higher than the YTM underlying bonds. And as chartered accountants, we know, and the reason is because in case of IRR, they take interim cash flow into consideration. The interesting portion also, of course, is that if they keep your duration constant, you can make more money. and it's something to keep in mind. While in case the yield curve is inverted as today, you can still make more money by leveraging across out there. And I'll give you live example rather than giving theoretical example here on this point. So let me give you quickly, conclude in next about 3 minutes. So in terms of the bond yields, we're talking bond yields to be highest since 2008. Inflation coming down, and of course, inflation comes out, the bond did very, very well. The best time to invest in bond is 6 months before the rate hikes. It makes tremendous sense for the family office sector to look into it. To give an example to you, if you look in terms of Jaguar Euro CDS, is giving you about 6% out there, while Jaguar bond gives you about 4% spread. So by just moving from Jaguar bond to a CDS, you can make 2% extra. And of course, if you don't want to like Euro, then you can move to USG, you make 1% on top of it. Now, how do you use the same structure in terms of fund? What you can do is you can convert the CDS into a CLN, and therefore you can get about 10% return in terms of Jaguar 5-year CLN. And because you are a fund structure, you can take a non-recourse leverage. And if you take non-recourse leverage, you will end up having 18% return in terms of Jaguar CLN versus a US dollar bond of Jaguar will give you about 13% leverage return. So a fantastic way how you can use a fund structure in terms of leveraging out there. I promised to you in terms of how the leverage works. So to give example to you, suppose the portfolio gives you 8% in terms of your return, and if your leverage 1.25, so basically means $1 of your own $1.25 of the loan you have taken is equal to $2.25. You will end up 8 into 2.25 is equal to 18% return minus the cost of borrowing of about 5 into 1.25. You make about 11% take home. Very, very, very important. So if this among the 5 slides you want to take home, I would take home this slide home to explain that ex-India specifically, you can borrow at a level lower than the return you get from the bond sector and higher return. Very, very important, because in case of family offices, the status substratum of family office is in terms of preservation of wealth, and therefore in terms of making sure that you have a higher allocation to fixed income. This is not theory. These are actual real numbers from Silverdale Bond Fund, October 2026. Just to highlight to you the fact in terms of the numbers there. I was very keen that in today's seminar, I use live numbers so that you can know exactly how it works. Again, the club deal, for example, it's again an example of going club deal. I can't give the name of the family, but this explains to you. So this is basically a fund which was created for the family, where 2 of the investors actually invested through the family vehicle. One investor invested directly, and one investor invested actually directly into the investee company. Very, very important, because in India, we still have chachadas where 3 people from, for example, IITs will come together, put a fund, and then you require one more a founder sector coming into play. Similar this example of how you can do a startup without giving a PG. I will leave the last 2 slides more to highlight this. So till now, almost all solutions for treasury management are based that the CA, who the CFO is God. He knows exactly when, how much money is required. But we all know that's only a theory. And today the beauty is that you need not believe in terms of estimate things like out there. With artificial intelligence and machine learning, you can exactly do a much more prediction in terms of when you require what money. And that is where the interesting portion is, that you can determine, for example, with 6 sigma level confidence that the stack 1 is the money you would not require, with maybe 2 sigma confidence that this money may or may not require, and this money you require. So instead of going the traditional way of ultra short, medium, and long-term bonds sector out there, you can create a portfolio exclusively for the cash flow as being predicted and dynamically change from time to time. So for example, if you're expecting a huge outflow in the month of November, we make sure that the bonds there'll be bonds maturing close to that. And similarly, if you're expecting a huge inflow coming later, we'll ensure that sufficient bonds will be there. This is the summary of what I've spoken to you in terms of how, for a large family, we can create multiple fund structures, which takes care of both the OpsCo, the treasury, which we talked about, as well as private equity investment they do, and of course the charities sector there. So thank you very much for your audience. I will also thank the various investors, platforms, and the database which have been supporting us. Happy to take questions.
Thanks a lot, Sanjay. You did a one-day workshop job in 40 minutes. Kudos to you. So this is nothing less than one-day workshop. Making it so concise was one of the Herculean tasks you've done. While we await members asking any questions on chat, let me kick off by asking, what is the role which our members based in India can play in the overall fund structure? Can you give us 3 bullet points around that?
So the 3 bullet points, first will be educating people. The first thing is that to explain to people that fixed income ex-India, for example, would typically have certain amount of leverage, and explain to them that what is not possible in India, they can do ex-India. So if you can buy a bond which gives you, for example, 7% return, you can borrow against it at 5%, and makes tremendous sense to increase the return that way. And that education the C has to do is this. Look, when you talk to people, look, how can a Silverdale fund, for example, borrow cheaper than the Reliance Industries? Calm down. Reliance Industries borrow on an unsecured basis. Silverdale borrows on a secured basis. So this small bit of education is something which is very, very important. And it's very important at today's juncture, because remember, in my 32 years of career, this is a rare time when the interest rate ex-India are higher than interest rate in India. So if you look at a 7-year, for example, Tata Motors, Jaguar, or Shriram Transport or JSW thing, you realize in India you could get about 6.5%, 7%. Ex-India you could get about 7.25%, 7.5%. So this is very important to educate people. There's a rare opportunities in life to do it out there. And of course, being an offshore security, as you know, it will be eligible for 20% of the capital gain sector, which I'm sure my Indian chartered accountants know better than me. And here is the additional value that you can add, that in terms of the families. So large families, of course, can use the gift city or the listed company route or the other route in terms of being able to use a bespoke fund to deliver on their various investment interests, specifically because most of the middle class Indian are having exposure ex-India.
Thanks, Sanjay. Thanks a lot. I would like to remind the participants to post the questions in the chat box, if any, and we'll wait for a couple of minutes. If not, then we'll proceed with the next presentation. While Sanjay is still with us, once we finish the next presentation, we can take more questions for Sanjay. I think there's one question which has come from Ayush. Can I read that to you?
Sure, please go ahead.
When it comes to Section 13U exemption by IRS, are the income earned by the fund exempt or also the fund managing company?
So 13U applies for the fund, which basically means 100% of the income of the fund is exempt from taxation. So let me distinguish between 2 things. So if any company business is, for example, investment, then it becomes a business income, not an investment income, correct? So the 30U actually classifies it to be an investment income. So whether it is in terms of capital gains, interest income, or dividend, 100% of that income would be exempt from taxation in Singapore, which basically means your money grows at much faster rate and much without any leakage of taxation. Not only that, Singapore does not have a withholding tax. So unlike a US fund on an ETF, where there's typically 30% withholding and see-through sector out there, in case of Singapore, your effective will be 0 taxation. And depending on the jurisdiction you are coming from, it could be 0 taxation or long-term capital gains sector for you. Coming to your fund managing company, that is a different ball game altogether. And being a regulated fund manager, of course, we can get something what's called financial sector incentive schemes for fund management. So for the fund managers, there is a separate incentive scheme out there.
Thanks, Sanjay. Sanjay, one more question from Piyush. Could you please elaborate on FATCA 1 and FATCA 2 compliances? Quick one.
So it's very complicated out there. So, okay, broadly speaking, let's go back and forward, which is this. In 2008, if you remember, among other things, the US wanted to know where the terrorist money came from. They couldn't do it, so they made a regulation called FATCA, and then we had a CS, followed the FATCA and sector out there. So what we need to inform to the tax authorities is in terms of the amount of investment and amount of returns a particular investor has made. And depending on the model 1 and 2, in terms of how reporting happens. So Singapore is model 1, which basically means we report to MAS and not to various jurisdictions in the world. In Cayman, for example, we report to various jurisdictions in the world sector there. So the advantage there is that it becomes much easier to do. I also want to highlight that even India is a member of the FATF, and therefore we do see from time to time the Indian tax authorities verifying the fact that the amount of investment people have done have they actually declared back in India also there.
Thanks, Sanjay. Two more quick questions before we move on. So Rohit has asked, how do you take care of the credit risk? It could get tough with leverage as it be a double-edged sword.
Very, very good question, Rohit. So let me clarify this to you, and it's very, very important for everybody to understand. The only way you can beat any index in the world is by the concentration risk. Think of an index which has 5 securities. You buy the 5 securities in the same proportion. There's no way you can beat the index, correct? If you buy 4 out of 5, you have chance of beating the index. So typically how the fund managers traditionally have been beating the index is by taking concentration risk. In case of fixed income, they were going down the credit quality by taking slightly riskier company and hoping that they will make more money. What we do as when we use leverage is exactly opposite of it. We like to be more diversified. Why? Higher the diversification, higher the loan to value. You require higher quality. Why? Because higher the quality, higher the loan to value. So the beauty there is that you can reduce all the 4 risks and replace by leverage. So post leverage, the risk return would be far, far, far higher. As we didn't get time and to go through it, so I would avoid that. But I just want to show one slide in 30 seconds. Not even 10 seconds. So this is a mathematical answer to a question which you asked, which is that for the same amount of risk which you're talking about, the return can, for the same risk, the return can be increased by almost 50% by actually increasing the allocation to bonds using leverage. Why does it happen? Because under the CAPM model, the risk parity portfolio moves up on the efficient frontier. So what would typically be 60-40 portfolio, this moves to year if you use leverage. To put in layman language, what I was given rocket science to you is that you're getting higher return for per unit of risk you take in terms of leverage. And that's the reason why we have about $3 to $4 trillion in the world using some sort of risk parity. So takeaway to you is that please don't get carried away with what is been hearing. Mathematically speaking, leverage gives you superior risk-adjusted return.
Thanks, Sanjay. One last question. There are 3-4 more questions which we will keep it for the end. So one last question before we move on to the next section. What is the advantage of Indian family office investing through Singapore corporate structure than investing directly in India or through Gift City? It's been asked by Madhur.
So first and foremost is that you have to take care of 3 different things. First is that in terms of the Singapore corporate structure versus Singapore corporate, which has a 13U exemption, namely a fund structure. Because if you do a normal corporate structure, then remember, depending on the facts of the case, you may or may not get tax exemption. I would say more likely than not, you are unlikely to get a tax exemption. So if you took a fund structure, it doesn't make sense. But when you do a fund structure, or even, for example, the Singapore corporate structure, the most important thing to keep in mind is round tripping. Because if you're sending money from India to Singapore and back to India, you could get it round tripping. Can you do round tripping? Well, you have to be careful because under the offshore investment guidelines which came in August 2022, yes, you can do round tripping as long as round tripping is part is level 2. We have 2 subsidiary level and it's only adjunct to your main investment. So, for example, if you send $100 from India to Singapore, or to which, for example, $25 is given back to India, that's permitted. Of course, assuming that other things are all well. So those are some complications you need to be careful about. But yes, as I always joke to people, remember whether it's a Wipro or a Tata Steel, they are actually a Singapore company because the holdco which owns the majority of the assets are in Singapore. And just a bit joke, but gives you color in terms of the fact that yes, it does make sense to use Singapore jurisdiction. I'm not authority on gift cities, so I will leave it to the end of the conversation if you still look at it further.
Sure. Thanks a lot, Sanjay, for taking us through your presentation and to replying to all the questions which were very interesting. We still have 2-3 more questions left, which we'll take towards the end. So now I would like to introduce Miss Adriana Caledron. Thanks for your patience, Adriana. You have been patiently listening and waiting for your turn. We will make sure that Sanjay also patiently waits until the time your presentation gets over. So Adriana is the Director Asia and Malaysia for Transfer Pricing Solutions Asia. She has extensive international experience with Big Four and mid-tier firms, advising multinational companies in the areas of corporate and international taxation across South America, US, Australia, and the Asia Pacific region. In Asia Pacific, Adriana specializes in the area of transfer pricing, building on her Latin American experience as a lawyer in commercial and tax legislation. As a transfer pricing practitioner, Adriana has advised companies in the Asia Pacific region across various industries and in a wide range of projects associated with planning, compliance, and dispute resolution with tax authorities. She has also participated in specialized projects involving pricing of financial transactions, business restructures, and negotiations of APAs. Most recently, she has participated in the transfer pricing planning projects to implement BPS action plan and the country-by-country reporting, which is a very important one. Apart from this, Adriana also enjoys teaching and has been involved in various transfer pricing seminars and workshops. Please note that besides being a transfer pricing trainer at the Institute of Chartered Accountants of Singapore, Adriana has also facilitated in training sessions for CFOs, tax teams of large companies and consultancies, and tax executives at the Australian Taxation Office. So vast range of experience across jurisdictions. Without further ado, I would hand it over to Adriana, and thanks for your time. Thanks for your presentation.
Thank you so much, Hemant. So let me just share first of all the slides. And I want to kind of build up on the concept that Sanjay spoke earlier about the aspects of TP that are, or the aspects of funds that are not very well known. Am I sharing the right slides, please, first? Yeah, all good. So what I wanted to talk about a little bit is the fact that Sanjay was saying that the aspects that are not very well known or spoken about funds. And I have to say that one of those topics is definitely transfer pricing, which is often overlooked in the context of fund management and family offices. And I hope that from today's session, everyone will take some key points on what to consider, because when it comes to setting up a fund management or a family office structure in Singapore, even though Singapore is quite entrepreneurial and business friendly, at the same time, they do expect some adherence to our legal and tax framework. So let's kickstart with some of the aspects for today before we go into the details. Similar to Sanjay, disclaimer, this presentation is for guidance purposes only, and you will need to look for an advisor for proper advice for your case. So just, I will skip the presentation, but just a little bit about our firm for those who are not familiar. We have offices in Australia, Singapore, Malaysia, and UAE, in all of them advising companies, multinational companies, family offices, fund management, and all sorts of multinational companies across any type of industry in transfer pricing. In Singapore particularly, Australia as well, and now recently UAE, we have done quite a bit when it comes to setting up structures that are transfer pricing savvy and tax savvy for fund management and family offices. So I first want to start with the point of explaining all the CAs in the room today. Why is transfer pricing an important topic for family offices and fund asset management? So I started always curious these days about what ChatGPT has to say. And I just did a quick look on ChatGPT. So why is transfer pricing important for family offices and asset management? And very funny ChatGPT reply, or interesting, because their reply as usual is, it is important for both to consider tax efficiency, compliance, proper allocation of resources, transparency, and risk management. With consulting, but the most important one that I like a lot, and I think some of the CAs and consultants here will love this as well, which is consulting with tax and legal experts is advisable to ensure transfer pricing practices align with the applicable laws, regulations, and the unique needs of each entity. So I think once again, I keep thinking to myself, are we, and I think everyone with this AI boom now, are we CAs or tax or lawyers going to be replaced by ChatGPT? And I have to say still no. Even ChatGPT say you have to go and consult your legal advisor or your expert advisor. So I think we are here to stay. But coming back to the topic of transfer pricing, let us go into the detail of what is the scope, what is the trigger. There is mainly, very simply, two conditions for transfer pricing. One, that there is control parties. What is control? Control can be exercised by ownership, common ownership, or more relevant for this topic, common management. So as long as there is an avenue to control a structure by one or more companies or individuals, there is control. And if there is control, then we start talking about transfer pricing. Condition number two is there has to be a transaction. And I will explain in some of the cases what are the most common transactions that we can see in this industry. That transaction, and I will explain a little bit in the case studies, can be domestic or cross-border. Now, what is the point of transfer pricing? That if there is a control party and if there is a transaction, that transaction has a price. And that price needs to abide to something called the arm's length principle, which is an international standard. This doesn't only apply to Singapore. I think some of the attendees today who are CAs will be familiar with this concept in India. And the reason why it is good to look into it, or why tax authorities want taxpayers to look into it, is because one can manipulate the price to shift profits from high tax entities to low tax entities. And I will explain this particular concept in the context of this industry. At the end of the day, when it comes to transfer pricing, what we are concerned about is first that most of the transactions are not artificial, that the transaction is not artificial, that is based on some commercial substance, some basis to it. And it's not only a paper transaction or an artificial transaction. And two, that the price agreed in that transaction is what is called arm's length, or in simple words, market price. Now, in the context of this industry, we can have various types of transactions. I will say the two most common, or the most common ones, are, and I'm going to highlight here, intragroup services, which I will explain how they can present themselves, loans and financial transactions, which I will also explain how it can present. And there are two others that are not as common, but nevertheless, I will share a couple of examples. One is intangibles, which can be in the form of brand names and know-how, and tangible property, which can be in the way of, in the form of sales of goods and spare parts. Now, why do I say that these ones are less common, but these days is becoming more common, especially the intangible one, because you will be surprised how many asset management structures are now trying to build up intangibles, but by using AI and what is called robot advisors and so on. So that could be the presence of an intangible property that may need to be licensed and so on, but it's less common. I will say that the two most common transactions are intragroup services, loans, and financial transactions. Okay. Just for information, the general provisions in Singapore that regulate transfer pricing is in the Income Tax Act. So transfer pricing is part of the tax framework of Singapore under Section 34D, where basically it states that related parties has to enter into control transaction in line with the arm's length principle. The definition is quite long, but in essence, that's what it is. As long as there is, as I was saying earlier, direct or indirect control. That's the key. Direct or indirect control. Now, one thing that we get asked a lot is, how do I establish this concept? As I said earlier, based on common management is one, based on ownership is a second one. But I have to say that this is one of the big gray areas of Singapore, because we don't have a definition in our Income Tax Act. So because we don't have a definition in our Income Tax Act, a lot of the times it needs to be assessed on case-by-case basis. And in fact, we have cases in this industry where we have been having to explain maybe to IRAs when there is control and when there is not control, to ensure that if there is no control, then there is no claims on transfer pricing. But because it's a gray area, you have to assess it case by case, but just broadly based on ownership or management. Now, how does it apply to this type of industry? And I will say not only trust structure, but family offices and asset management. Most of them will have related party transactions. Why? I bring back one point that Sanjay talked earlier, which is the split of revenues and operational cost. That split, a lot of the times, will end up in some form of transaction that needs to be looked at from tax and from transfer pricing point of view. So one typical example is a related party transaction involving a Singapore trustee that is outsourcing the back office services, trust accounting, to a shared service center. Some of other examples that Sanjay said earlier as well about how to split corporate fees and some of the legal fees among the many funds, etc., etc. So that is present, and that triggers transfer pricing. what is the link with tax? So why are we concerned about transfer pricing, and how does it apply, or how does it interlink with tax? So essentially, there are two key things. Oh, how does it apply to family office first? So again, similar to what I said earlier, there is the possibility of having transactions between the family office and the investment fund holding assets. That can be both domestic and cross-border, and both of them will be subject to transfer pricing in Singapore, because for those of you who don't know, in Singapore, we have transfer pricing for both domestic transactions and cross-border transactions. Now, some of you will be thinking, but why domestic? The reason is basically because we have a big incentive program in many industries. So we talked earlier about Section 13U, which is the incentive program for funds and asset management industry. So Sanjay was saying earlier that we have the fund being fully incentivized and taxed at 0 rate, but because it might have fund management service or a fund management office, that entity will not be subject to that incentive. And that will create potentially a transaction that needs to be looked at, because the concern from IRS is a tax leakage from the fund to the manager by underpricing what is paid to the fund manager, basically. So we will talk about that more in the example. Now, coming back to what's the link between transfer pricing and tax. Essentially, any taxpayer in Singapore will have to prepare its income tax return. Now we are very close to our due date in Singapore, which is 30th of November 2023 for financial year ends 2022. And what we have is that any of the transactions in the context of transfer pricing has an impact in the assessable income that is used for the purpose of my tax return. And it can also has an impact in the deductions claim. So if I underestimate my price in a controlled transaction, effectively, I could be underestimating my tax position in Singapore. And if I do that because I basically, as a taxpayer, didn't plan properly for the price in a controlled transaction, I could be subject to a tax audit if I get caught. And if that is successful, I can be subject to tax adjustments as a result of mispricing in controlled transactions, which is transfer pricing again. And I could be subject to penalties as well. So that is the issue, that transfer pricing is not a discipline that basically lives on a standalone basis. It is a key part of tax. Now, one thing just for information, once you submit your tax return in Singapore from a corporate point of view, if you have to amend and you have to do adjustments after you presented your tax return, and those adjustments are related to transfer pricing, they can be quite difficult to do. It's not that easy to go forward with IRS to request voluntary retrospective adjustments. So that's why it's extremely important to have it properly done by the time you lodge your tax return, because trying to fix it later is an issue. So how do we generally approach transfer pricing, just for information here before we go into the cases? For fund asset management and fund and family office industry, the approach will be in theory, very similar to what we will do in the context of any other industry, which will involve essentially conducting a business and a functional analysis, an industry analysis, selecting a methodology to test your transaction, and conducting a market benchmark. Now, and then within the methodology, we will have 5 very well-known transfer pricing methods that they not only apply in Singapore, but they are well recognized worldwide. Those of you who have or have experienced transfer pricing in India will be familiar with them. So they will be comparable on control price, resale price method, cost plus method, profit split method, and the transactional net margin method. So these are the 5 methodologies that we have to test any of the control transactions. And I will explain in the case studies what are the most common that you can apply in the context of asset management and family offices. So let's go to the 3 case studies to elaborate more, so make it a little bit more practical and people can understand what's the trigger. Let's go to a scenario 1 where we have a single family office or as SFO. And you will have here then, let me just point the laser, use the laser. So you will have the family office and the fund vehicle. And as Sanjay said earlier, you will have an investment management agreement. And as we say earlier, the fund will be subject to a very good incentive, which is definitely very appealing for setting up a fund in Singapore. And then you will have the family office. So this investment management agreement will be caught under transfer pricing because the fund and the family office is considered, in theory, related parties. And I say in theory because it doesn't necessarily is in every case. So this investment management agreement needs to be looked into to make sure that the price that is agreed here is in accordance with the arm's length principle, which is basically based on transfer pricing provisions in Singapore. Now, one of the questions that we get always asked is, does it matter if it's cross-border or domestic? And the answer is no. Both cross-border and domestic will be caught under transfer pricing. Cross-border, obviously, because we are having different jurisdictions involved. But if it's domestic, the trigger will be the fact that one, which is the fund, is subject to an incentive and a 0 tax rate, whereas the family office or the manager may not be. So that will be the trigger because, as I said earlier, in Singapore, we have transfer pricing for domestic transactions when the taxpayers in Singapore are subject to a different tax rate, not effective tax rate, headline tax rate. So that will be the trigger here. Usually the debate here is around how do we price this IMA? What is the right methodology? And that has been quite of a debatable topic because some people believe, oh, maybe it's just a split, or no, maybe it's just a normal cost plus arrangement. That is the key question and the key challenge here. And not all the time is one answer. Each answer depends of the type of investment management agreement and some of the responsibilities involved in that IMA. So let's go through a little bit of a more complex case, which is basically the scenario 2 in the context of a little bit of a little bit more complex and more facts involved in it. So we have a trustee, a trust, a BVI hold company. We have a Singapore OPCO, a Malaysia OPCO, and a bank account that is held by the BVI company. So I mentioned earlier that here you could have some shared services that may be provided by another control entity within the group. And that shared service center could provide services to Trust, but even to Malaysia OpCo, to Singapore OpCo. So that shared service center will be considered a service provider to the whole structure. And then the question here, or the two key, that will be considered a transaction. So a service transaction that is being provided by this shared service. So the question here is two key things. One that we typically get asked is, how do we split the cost? What is the basis for splitting the cost across? And two, what's the methodology as well? What is the methodology that is correct under transfer pricing provisions? And then obviously one consideration as well, if this is cross-border, it will be as well, okay, how do I come up with a price that is suitable both to the overseas entity that I may have the shared service and to Singapore as well, which is always the issue about transfer pricing. You could have also some loans coming from the BVI entity to the Singapore OpCo and to the Malaysia OpCo. Being channeled down to the Singapore OpCo, then channeled down to Malaysia OpCo, and then have a contract here. That loan between these two OpCos is also subject to transfer pricing because there is control, common control, which is the BVI HoldCo. And in this case, then you will also have to look into the two key things, I will say. First, that the funds that I'm channeling down to Malaysia OpCo are in line with the arm's length principle, because in Asia Pacific region, I will say excluding Singapore, there is tax regulations around the level of leverage that a company can take from in general and the level of interest deductions that the company can take. Malaysia being one of those countries. So I will have to take into consideration first that, two, if my interest rate is at arm's length and is a market interest rate. Then we will have a third scenario where I could have a situation where I have a private trust company that has a holdco in Singapore that operates as a treasury company, and I could have in this side a trading arm, and in this side the single family office. So here I could have actually three different types of transactions. One, loan and treasury services coming from the Singapore holdco to the Indonesia or to any other, which that will trigger two key things. One, that we already spoke about, what is the correct approach for an intercompany loan, which we already mentioned, the level of debt or the level of capital and the interest rate, both of them equally important. The second will be the treasury service, which Singapore might be providing and will need to be remunerated for. The second transaction could be here an Indonesia leased company that is doing sales to a Singapore distributor. And then that sales, because again, they're all controlled parties under the same ownership control and probably management control, then what type of, or what is the price that is in compliance with the arm's length principle? And similar to structure one, I will have here the investment management agreement between the SFO or the single family offices and Fund 1 and Fund 2. And this transaction will be again subject to transfer pricing, and some questions here around how do I price the IMA with the two funds and so on, and what's the right approach to make sure that this is at arm's length. So just to wrap up a couple of things before we move on to any other questions that we have, I think key highlights from my session today that I hope everyone keeps in mind. So obviously, when it comes to setting up a fund or an asset management structure in Singapore, there is some key things to keep into consideration. One is the legal regulation, which Sanjay kind of talked about, the licenses side, the tax and the transfer pricing side. I think in general, Singapore has a very, very good advantages as a place, as a country. The tax regulations are very beneficial for the industry, I must say. It's just that there has to be a strict adherence, and that's why it's important to find the right advisors for this purpose. I think that's pretty much just to wrap up. I think Sanjay already talked about wealth preservation, and I guess my point is tax efficiency in the context of, you know, both the domestic tax regulation and the transfer pricing regulation, making sure that you looked into the compliance and risk management aspects as well. We talked about the revenue and the cost allocation, which has a accounting aspect, a tax aspect, and a transfer pricing aspect. And those will impact the way in which the asset management or the family office conducts the business operation. I think with that, we can open the floor for questions, Hemant, and happy to take any questions from all of you.
Thanks, Adriana. Thanks for this wonderful session. I always enjoy the session where there are case studies because we relate to more cases than theory. So thanks for taking us through those case studies. So we will wait for chat box to be filled with more questions for Adriana. While we have two more questions, which in the meantime we can ask Sanjay to answer. He has kindly typed all the answers to wherever he could in the Q&A box. The remaining ones I'll just quickly glance through for you. So Dipen has asked, is there any special window for HNI to invest in overseas funds, family holdco, other than LRS window? RBI ODI guideline generally allows investment by Indian operating companies for their JVs, subsidiaries, but need clarity on setting up holding investment companies.
See, we don't claim to be Indian tax experts. I'll put a caveat there. But from whatever we have understood from our partners in India, and we do have banks as well as wealth advisors working with us, LRS is very straightforward, $50,000 per person per annum, including for in case of minors. In terms of the investment by listcos, we don't think there is a limitation because we can confirm to you we do have money from listcos in India. In terms of using FIF structure through GIFT City, we have heard about it. We know as much as you know, in terms of the first FIF to finally be operational. We haven't seen it happening, but we would be careful in terms of those. In terms of using the subsidiary abroad in terms of investing through it, I would suggest to refrain from that. But just to conclude once again, we are not Indian tax expert. It's better for you to look in terms of local chartered accountants who will help you better.
Thanks, Sanjay. As always, these are basis our experiences, and these are not tax advisors which we are giving at this on this platform. So moving on, a quick one. Does FSI exemption section 10L currently introduced applies to investment funds also? Do you have any idea, Sanjay, on this?
As I mentioned, prima facie, no, but you need to look into specific cases, because for the purpose of presentation, I made it very simple. But in reality, what happens is when we invest, we do use SPVs, we do have co-investments, we do have use derivatives sector there. So those could complicate the things. But yes, if it was to be a simple vanilla structure, the answer would be no.
Thanks, Sanjay. One question for Adriana, which is by Ayush. What is the ideal margin that SFO fund management company should keep if using a cost plus method in transfer pricing for the management from the SFO?
If only I had a dollar for every time I get that that question. I guess my answer will be like, before going into methodology, you first need to assess whether that is the right methodology, because that is not the right methodology in every SFO case. So you first need to assess what is the right methodology, if cost plus is really the one. And two, what is the type of activities that are being performed? Because even though the IMA is a standard, a lot of times can vary what is the type of activities that are being done. So that will drive what is the margin. There is not really standard margins, to be honest. You have to look at it case by case.
Thanks, Adriana. While we are on this topic, we'll encourage participants to ask any more questions which they want to pose to Adriana or Sanjay, since we have some more time left before we wrap up this session. I can see some participants still typing in, so we'll just hold on for a couple of minutes. Sanjay, would you like to take that question which you're answering for Jitendra?
Okay, there are about 10 questions have been asked to me, so let me share for the benefit of the audience at large. So a few questions which have been asked is, and I'm going in no specific orders out there. First is that the leverage which I talked about, is it possible in India? The prima facie answer is not easy to get in India, because the depth and width of the market is much lower. In terms of the question which we asked, it's in terms of VCM or RCM. So we have something called Venture Capital Fund Management License. It's primarily for investing into various ventures to startups. The requirements for that is much lower. For example, for a fund management license, you require 10 years experience. For a VCA FM, they typically will be happy with even 5-year experience. But you have put the limitation in terms of what also you can do. Namely, you have to invest into startup stroke into venture capital. And the question is in terms of RFMC versus LFMC. RFMC is a registered fund management company versus licensed fund management company. Registered fund management company is in case you want to invest, manage less than 250 million Singapore dollars. And the maximum number of investors allowed is 30. So for a startup, yes, definitely for a fund which is starting up, it definitely makes sense for you to look into RFMC license. Is far easier to get a RFMC license than getting a full-blown fund management license as we have. Both in terms of the management controls, in terms of the infrastructure which you require, all from all point of view, it will be easier. Caution is when you talk to large institutions, then they would obviously prefer to that you have a CMS license, capital market service license, or license fund management as it's generally called. Then the question has been there in terms of the timeline is sector out there, depends on of course, each individual investors can't be very sure about that. Then the question is in terms of which will be easiest to get. By definition, easiest will be venture capital fund management, but the work which you can do is very limited. Among the RFMC and LFMC, it's a practical call. I recommend you to look into RFMC to start with. But the underlying, which I want to highlight once again to you, is that if you want to come to Singapore and live in a hotel, please hire a room. Don't buy a hotel. The reason why I say that is to remind you once again that it may make tremendous sense for you to actually hire a fund for the time being, because there's no point in you spending 1 year waiting for license to come in and for having 3 people on your payrolls before it comes, and then once it comes to then waiting for another 3 months to do a ISJA stroke JIMRA transaction, JIMRA agreement with your prime brokers in order to get the lending limits, in terms of taking a couple of months to get the bank accounts open, etc. there. So I strongly recommend you hire a fund, be up and running in 1 month, concurrently build your capabilities, and once you have sufficient capabilities, say for example RFMC, you can take over the management, and once your asset size crosses to 50 million Sing dollars, then you can look in terms of leverage fund in the company.
Thanks a lot, Sanjay, for being such a brand ambassador for Singapore tourism. Rather than people buying hotels and stoking inflation in Singapore, you are promoting tourism. So thanks a lot for that. I think with this, we don't have any more questions, which I can see in the chat box or in the Q&A. I would like to invite the management subcommittee member, CA Nikhil Jain, to wrap up the proceedings and for a vote of thanks. Nikhil, I can see you online. Would you be able to unmute yourself?
Yeah.
Thanks, Nikhil.
Thank you. Thank you. Can you hear me, Hemant?
Yes, we can hear you. Over to you.
Thank you, C. Hemant. What a lovely treat it is to hear the experts in this topic. We always keep coming across the edges of this topic because we have a transaction, and then there is an involvement of this particular topic in the subsequent scenario. So it's always to understand what are the precautions, what are the preventions, and therefore what are the preparations that are involved. And thank you, C. Hemant, for taking us through, for helping us navigate through the session. I would first and foremost like to thank CA Arpit Kabra from WARC. It's a great partnership that we are having along with Singapore chapter across these two extensions of ICI, and therefore it's great to have this particular collaboration. Along with that, I would like to thank CA Somnath, the chairperson of Singapore chapter, and CA Nishant, the vice chairman of Singapore chapter, who have been there with us to have multiple of these events. And at the same time, now, since we are improving in terms of these collaborations, I think these discussions at the leadership level also is very important. I would like to thank the management committee of both these organizations, WARC and Singapore chapter, who have enabled this particular session. Thank you, CA Sanjay, for taking us through the topic, because it's kind of home for family offices and fund management, but to hear it, how it happens, to hear how some of these interesting stories develop, it's always interesting. So thank you, C. Sanjay. And at the same time, I would like to thank Ms. Adriana as well, who has been very patiently and with some of the details. Adriana, you explained these topics, and I could see that although some of the basics were there, but it's always, like I mentioned, the edges are there, and therefore we have to be careful of those edges of the topic, and then make sure that we cover the things carefully. So thank you everyone for joining us in this webinar. We really hope that this particular thing was useful for you. And once again, thank you, C. Hemant, for taking us through this one.
Pleasure, Nikhil. Thanks a lot. Thanks a lot to the speakers and Nikhil. With this, we'll conclude the session for the evening. Thanks a lot, all the participants, for joining in.
Thank you, everyone.
Thank you.
Have a
Thank
great
you.
evening. Thank you.
Thank you.
Take care.
Thank you.